Welcome back to Investing Talk Podcast.
Today, we're analyzing a company making, well, one of the most significant and timely pivots in the current market, CleanSpark.
CleanSpark, okay. So for years, they were known almost exclusively as a Bitcoin miner.
Right, a powerful one, leveraging cheap energy to produce crypto. But the core mission now, and what we need to understand, is how they're aggressively transitioning that legacy crypto core into this emerging engine for AI and high-performance computing. HPC, basically.
That's a critical shift. I mean, you're moving from mining digital gold to powering the entire future of computation. So what's the ultimate consequence of this massive pivot for investors?
So what is simple? If they execute, this transition positions them as a highly leveraged play on the single most critical infrastructure shortage facing tech today.
And that is reliable, low-cost power.
Exactly. Reliable power for AI data centers. Bitcoin mining gave them the expertise. Now they're just pointing that expertise toward a far, far higher margin business.
I appreciate that framing. Today, we're looking at CleanSpark. As usual, before we start, subscribe, like, and comment to this video to support the show and stay informed. Okay, let's unpack this business, starting with the numbers. What does the fundamental foundation look like before we even get into the speculative AI potential?
The foundation is surprisingly robust, and it's built entirely on their past success in Bitcoin mining. We're looking at explosive historical growth.
Oh, explosive.
Their revenue went from about $39.3 million in 2023 to a staggering $131.5 million in 2024. That is 234.78% year-over-year growth.
Wow.
Yeah, that is truly rare to see in a public company.
Triple-digit growth is phenomenal, but look, as any company scales up, that pace is going to slow down. What does the forecast look like now that they're shifting focus and pouring all this money into the AI build-out?
You're exactly right. The deceleration is natural. It's expected. Future growth forecasts are more grounded but still strong, somewhere in the 21.8% to 55.8% range into 2026.
Okay.
But more crucially, the company has hit an earnings inflection point. They're projected to reverse a pretty substantial loss of negative $1.35 per share in 2024 and move to positive earnings of $1.12 in 2025.
So that shift from heavy loss to definitive profit is a huge de-risking event.
A massive one.
But I'm immediately noticing a strange kink in the 2026 forecast, and this is where I get a little skeptical. Analysts are projecting a sharp EPS contraction of, minus 39.0%?
Mm-hmm.
That kind of drop usually signals operational trouble, so why are analysts just shrugging this off?
That drop is the most important nuance in the entire fundamental story. You can't ignore it. It's actually a classic strategic profile we call invest now, harvest later.
You are?
That contraction is not driven by operational deterioration. It is definitely not a signal that demand is falling.
So what's driving the earnings down then?
It's driven by heavy capital expenditure, CapEx, being poured into that massive Texas AI data center build-out. This is a company deliberately depressing its earnings in the short term. They're trading 2026 profits for potentially massive 2027 and 2028 profits.
And the market sees this as strategic spending.
It does, because that dip is immediately followed by a strong recovery forecast. Plus, 45.6% EPS growth in 2027. They're slowing down now to speed up later.
That makes the risk profile much clearer. It's an execution risk, not a solvency risk.
Okay, so how are they funding this? Building 890 megawatts of capacity in Texas is incredibly capital intensive. We're talking billions.
They are funding it with what can only be described as a fortress balance sheet. And that's key to mitigating the very execution risk you just mentioned.
Okay, fortress balance sheet. Break that down for us.
Look at their leverage. Their debt-to-equity ratio is only 0.30.
And for our listeners who might not track financial ratios daily, what does a DE of 0.3 actually mean in practical terms?
It means they have just 30 cents of debt for every dollar of shareholder equity. That is incredibly conservative leverage, especially when you're funding a massive new build-out like this.
And they secured financing. They did. A substantial $1.15 billion in financing, specifically for this Texas expansion, which proves their access to capital.
So they are conservatively leveraged and have strong financing secured.
Exactly. And this is backed by immense liquidity, too. Their current and quick ratios are both clocking in at 4.18.
Which means they have over $4 in liquid assets for every dollar of short-term liabilities.
Right. They have the financial muscle to weather almost any construction delay or unexpected cost.
That financial discipline certainly gives them the runway. But now let's move to the competitive side. What's the actual edge here? Why would a major AI player lease their power from CleanSpark instead of just, going to an established cloud provider? What's the moat?
It comes down to two moats, really,
Hmm.
and both come from their mining past. The primary moat is proprietary access to low-cost, reliable power in ERCOT.
And for those unfamiliar, ERCOT is.
It's the Electric Reliability Council of Texas, basically Texas's own independent energy grid. It operates a little differently from the rest of the U.S. And CleanSpark has two strategic developments near Houston, creating this hub with over 890 milliW of potential capacity. This infrastructure, the power contracts, the land, that's a multi-year, capital-intensive barrier to entry,
Something a competitor can't just replicate quickly.
or cheaply. Access to power is everything in the AI race.
Yeah.
We've seen stories about companies failing to get utility connections for years. 890 milliW is a staggering amount of power to control.
And the second moat.
Operational expertise. As a leading Bitcoin miner, they perfected managing these energy-intensive, heat-generating workloads. That playbook transfers directly to managing high-density AI data centers efficiently. They just know how to maximize output per kilowatt hour.
That makes absolute sense fundamentally. The financial profile is strong, the moats are clear. But let's pivot to the charts. If the fundamentals are so sound, does the market actually believe this pivot story yet?
The chart suggests that institutional investors are definitely starting to buy the narrative. The stock is currently trading around $10.65, but that's a full 45% below its 52-week high of $23.61.
Hold on, 45% below the high. If the story is this compelling, why hasn't the market priced in more of this potential? Why is it still sitting at such a discount?
Well, that discount is exactly why the opportunity exists. It suggests a lot of room for mean reversion, but it also reflects that execution risk you and I were just talking about.
The market needs proof.
Exactly. It needs proof they can actually lease out that 890 milliW capacity. But we did see a breakout confirmation following the January 14th and 15th news about the Texas land deal.
Right.
The stock surged past that crucial $12 to $13 resistance zone. That move confirmed the market is willing to pay up for the thesis.
And I always look for a breakout confirmed by heavy volume. Does the conviction hold up there?
It does. This looks like real conviction. Average daily volume is about 34.7 million shares. But during that recent rally, we saw sustained, elevated volumes near 27.2 million.
So institutional accumulation, not just retail hype.
It strongly suggests the smart money is driving the momentum.
Given all this, what are the professional analysts projecting for the stock price?
The targets are aggressive, and they reflect that blue sky potential. The analyst consensus target is $23.83, which implies about 100% upside from here.
100%.
But here's where it gets really interesting. The highest target out there is $30. That'd be a 152% gain.
Wow, $30. That is essentially saying if this works, it really works. That wide dispersion tells me there's some genuine uncertainty about the value of that AI capacity.
Precisely. If they secure one major lease, $23 becomes plausible. If they lease out a majority of that 890 megawatts to multiple players, then the $30 target becomes entirely achievable.
It's a classic high-risk, high-reward bet on execution. The technical setup looks compelling, suggesting the market is reacting. Let's move on to sentiment. Who is actually moving the stock, and what are the headlines saying?
Sentiment is overwhelmingly positive. Our quantitative sentiment score is strongly bullish, about 0.42 average. And that's supported by the headline ratio.
Which is?
6 out of 8 high-relevance articles showed a bullish signal. That's a 75% bullish headline ratio. The story they're telling is clearly resonating.
And what were the two big catalysts that drove that recent wave?
The first and most important was that Texas AI data center acquisition on January 14th. This was a definitive agreement for up to 447 acres in Brazoria County.
And this land came with the power attached.
Yes, a secured 300 milliW load with potential to expand to 600 milliW. That's what created that regional hub of over 890 milliW. It's the kind of scale the market needs to see.
And the market loved it, sending the stock up 4 to 13%. What was the second catalyst?
The second was Northland Securities initiating coverage on January 13th. They came out with a very strong outperform rating and a $22.50 price target.
And their reasoning.
They specifically noted abundant opportunities for HPC leases on attractive terms. That indicates the institutional demand for this capacity is real and just waiting.
So the overall analyst consensus must be incredibly bullish.
It is. 11 analysts now rate the stock a strong buy. We mentioned Chardon Capital holding at $30, and BTI raised its target from $22 to $26. When you see established firms raising targets because of the AI pivot, that's a huge confirmation.
Let's talk about who's trading the shares. We have to contrast the institutional flow with the insider flow, which can sometimes tell a different story. What are we seeing here?
This is a classic mixed signal that requires a bit of context. On the bullish side, Institutional ownership is high at 43.12%, with recent accumulation by huge firms like Ridge, Dimensional, and Tudor.
So large asset managers are positioning for this. A clear vote of confidence.
It is.
That's the bullish signal. But let's look at the caution flag. Insider selling. We can't just gloss over directors reducing their positions.
Right. We did see directors reducing positions in December 2025. One director, Cavallari, sold 33,000 shares. And that always raises legitimate questions, especially when the stock is 45% off its high.
Every strong thesis has hurdles. Let's formally consider what could derail the path to $23. My first concern is exactly that. Execution and dilution. That $1.15 billion raise and the $890 million build-out are huge if they face delays or cost overrun.
Or if they can't secure tenants fast enough.
Right. Then additional equity raises could lead to massive shareholder dilution. That feels like the fundamental risk here.
That is the single largest risk factor. But the company has built significant mitigation into its financial structure. Remember that incredible financial flexibility we talked about?
It's a 4.18 current ratio.
Exactly. That and the 0.30 debt-to-equity ratio provide a substantial buffer. If they face a 6-month delay, they have the cash to absorb it without panic.
But cash buffers run out, especially on a billion-dollar project.
True. But the key mitigation is this. The existing, profitable Bitcoin mining operations generate steady, robust cash flow. This means they are not forced to tap the equity market immediately if construction hits a snag.
So the legacy business is a safety net.
A substantial one, which greatly minimizes that dilution risk. They have options.
That's a critical offset. Now let's go back to the insider selling. It's a real red flag. Why should we ignore that apparent loss of confidence?
I wouldn't say ignore it, but you have to look at the context and timing. The sales occurred in December 2025, right after that massive $1.15 billion capital raise was secured.
Okay.
So it's highly plausible these sales were related to tax obligations or maybe portfolio rebalancing after such a large financing event, rather than a true operational concern.
So potentially non-operational selling, but it still matters.
It does. But the countersignal is far stronger. You have robust institutional accumulation, plus the fact that insiders still own a material 2.65%, they haven't abandoned the stock. If the big funds are buying while a few directors are selling, I tend to lean toward the professional money being right about the long-term thesis.
Okay, we've covered huge growth potential, massive spending, execution risk, and the strong offsets. What's the final verdict from our analysis?
The final verdict is a highly bullish score of 8.2 out of 10. That is a very high conviction rating in this sector.
And summarize the final rationale for that score.
CleanSpark offers an asymmetric risk-reward profile that's just hard to ignore. The foundation is incredibly strong, 234% YoY revenue growth, a fortress balance sheet, massive liquidity.
And the first mover advantage.
A huge first mover advantage in translating power infrastructure from crypto to the AI energy crunch. Yes, the 2026 EPS contraction is a trough, but it's a temporary, manufactured one that precedes a massive margin expansion in 2027. We think the risk is well worth the potential reward.
What kind of time horizon are we talking about for realizing that 100% upside to the consensus target?
We'd recommend a 6 to 12-month multi-quarter hold. The structure right now is favorable. Entering at the current level around $10.65 gives you a 45% discount to the 52-week highs, a good margin of safety.
And what are the specific catalysts we need to watch over the next 3 to 6 months to prove this is all working?
The next 3 months will focus on Q4 2025 earnings and, critically, the timeline for the Texas data center milestones. But the crucial catalyst, the one that validates the $23 and $30 targets, is the announcement of signed AI HPC tenant agreements.
The market needs proof.
It needs proof that the immense demand we're hearing about is converting into tangible long-term contracts.
Yeah, it makes perfect sense. The story is power. The proof is a signed lease.
That is the entire thesis. And here is the final provocative thought for you. The $30 bull case hinges entirely on leasing that massive 890 milliW capacity. Northland's commentary about multiple potential tenants actively seeking power is encouraging. But imagine the impact if that results in a partnership with a major hyperscaler.
Like an XAI or an Anthropic.
Exactly. A huge established name. If a partnership like that gets announced, how quickly does the market price in 150% plus upside? That is the real blue sky opportunity here.
That gives us a lot to think about as they transition from the crypto world to the AI power infrastructure space. If you found this analysis helpful, remember to subscribe, like, and comment to support the show and ensure you catch our next thorough exploration of the market.